Hey, great to see you. Happy Friday, May 9th, 2025. You're about to go on the markets with Sonoma Wealth Advisors. My name is Dano Weir. I'm the marketing director for the firm. I'll be joined in mere moments by Daren Blonski, CFP, Chris Sipes, CFP, the co-founders of the firm. This week, we're talking about the impact of tariffs in real numbers. We're looking at international stocks versus U.S. Does the run continue for international stocks? Big drops in the S&P 500 and what that means with returns moving forward. But the key question that everyone's looking towards, deal or no deal? Does the entire market just hinge on these tariffs and whether Trump can or cannot make a deal with China this weekend? We're going to find out in just a moment. Like, does the rest of the market even matter at all? Does earnings matter at all? Do fundamentals matter at all? Do technicals matter at all? Is it all just these trade deals, Chris? That's, I think, the key question. I think we're starting to wonder.
Yeah, I think so too. And when you look at the market, what is the market saying? I'm just looking back on 6 months. And if you look there, the S&P is only down, just shy of 6%. So call it 5.5. So that's the larger U.S. companies, and the NASDAQ a little bit less than that. And so really, for the big companies, at least, it's saying either tariffs are not going to happen, they're not going to happen as badly, or they just don't really matter. However, for the smaller companies, based on that index, is down about over 15%. So for the little guys, it does matter. They probably won't be getting the exceptions. They probably won't be getting the carve outs. They can't afford the lobbyists, et cetera. So the market right now, at least, is saying it's sort of going to matter depending on the size of the company.
This meme is perfect because it so defines how the average investor feels, which is, if you're listening, you've got a kid holding what looks like a brick and it says stock, and he's asking an older guy, he says, so what do I do now? And the older guy says, now you wait, right, Daren?
Yep, pretty much. That's what it comes down to. Now you wait. And I think we're still in a waiting pattern. I'm going to show you that when we look at the S&P 500 here in just a minute.
Oh, sorry, Dan. I forgot to silence my phone. I'm sure I'm going to get a text message from you soon, or a Teams message. I apologize. And I also forgot to turn off my Teams notifications. So apologies, Dano.
I'm going to take you up. I'm going to take you up with our compliance officer for that.
That's right. This meme was from Stansberry Research, and it was referencing Mr. Warren Buffett, who announced his retirement this past weekend. And they've got a quote from Buffett that says, "We don't get paid for activity, just for being right. As to how long we'll wait indefinitely." And I know Buffett's not perfect. He's a person, just like Charlie Munger wasn't perfect. But as an investor, I cannot think of any business person or investor that's impacted my life personally more in terms of, books read about them, philosophy of life and investing. Just a huge pillar of our time. And it's kind of crazy to see him hang it up after all these years. 94, I believe, years old. And he was still sharp as could be, answering questions right off the top of his head. Went for several hours at the Berkshire meeting like usual. And he still got it.
What does it mean to you to see him hang it up? I mean, what you're saying, you're talking about how inspirational he was. I mean, what is that? What do you think he's going to do next?
Yeah, I think that it's really he kind of is the last of an era. where I don't know. I respected the fact that he didn't have a social media. He didn't, lower himself to saying bad things and like, he was, again, he wasn't perfect, right? Because the people on the inside of the financial markets say like, look, even though Buffett looked like this folksy, charming old guy, he was actually a shark. And I'm sure he was. He had to be an actual, one of the best investors, if not the best investor of all time. You don't get there by being, dumb, right? Or soft. But he just had, I don't know, I guess an era of class, in the way he did things. From an investment perspective that just and he was willing to share his knowledge with others and people on how he thought you should do it. So I actually think this account that goes by Compound 248 really nailed it. He said for 60 years Warren Buffett did it his way. His way was also the right way. Life is well lived when the internal and external scorecards align. In business, nobody has ever done it better. I think I kind of feel very similar to that. And the returns, are reflected where he over his time period compounded at 5 million%, while the S&P was up merely 39%. So 39,000% versus 5.5 million. So, it's the proof is in the pudding. He's a legend.
And if you're looking at this closely, 1999, 19% loss, 3% loss in 2002, 31% in 2008, right? So this is considered the best investor of all time, and he has a 30% loss on his books. So, that this is up and to the right is not always the case.
Yeah, right, exactly. So
that what's interesting about that time when you had that 30% loss, like I remember just vividly the headlines at that time were like, "Oh, Buffett's lost it. He doesn't have it." And now he's sitting on how many billions in cash?
Yeah.
I just think it's so interesting. And, the financial media at the time was just shredding him. And I think how important as an investor not to let these short-term things impact your long-term scope. And I think that's a hallmark of a great investor. And I think something that a lot of people struggle with these days.
Yeah.
I guess all days it's been the case.
Right. And I think Buffett himself would say one of his real superpowers was being unaffected emotionally by stock prices. Now, if you read the books about him, he was unaffected emotionally about a lot of things, maybe to his detriment. And, anybody that reaches that pinnacle in, sports or any type of career probably doesn't have, a balance in their life. And Buffett was definitely the same thing. He would walk around his house reading financial reports and, step over top of his kids because he wasn't even paying attention. Right. He was so engrossed in what he was doing. So it's tough to find a balance, but anyway, tariffs.
Well, I think there's a great investment before you go on. There's a great investment lesson there, right? Because you have Buffett who displayed these very unemotional affects as a person, characteristics as a person that participated at least on some level, helping him be the great investor that he was and is. But it's interesting, I think, like many things in life, one, like when you have someone who's really good at one thing and they're not super well balanced, how our society like circles around that. And like, that's amazing. You think of like an athlete, or you think of like a great musician, and these other parts of their life often suffer. And I think that's important to also understand from an investing standpoint, that a balanced human brain that emotionally is adapted and connective to the world around it struggles to invest. Like the way the brain is designed is not ideal for long-term successful investing. And I think as investors, if we can accept that as a reality, the game gets a lot easier, because often the right decision when it comes to investing is not what your brain is screaming at you to do. It's the
That's
opposite
right.
of that.
That's right. And realize your competition, right? Buffett talks about the businesses that he started when he was a kid. He bought his first stock, I don't know, when he was like 12 or 11 or something like that. And he lived and breathed, investing for, 84 of his 94 years, literally all day, every day. And, in a very unbalanced way versus, the average person, they say the research on an individual stock before they buy is around 6 minutes. So, you're going into the market with maybe not a ton of Buffets, but there's a lot of very, very smart people. It's like picking up a basketball and saying, hey, I'm going to go, compete in the All-Star game. Like, you really need to check yourself in terms of your confidence as far as like your decisions are that much better, because Buffett makes it look easy, just like the Michael Jordans of the world make it look easy, but it's anything but easy when you're actually in that position. Anyway, I could talk about Buffett the whole time, guys.
We should do a special episode. Chris memorializes Warren Buffett before he dies.
Yeah, much more fun topic than tariffs. I thought this was a good visual, showing the, like if you had goods as a boat, what's the total value versus how much of that is going to be the tariffs on the Chinese goods. And so just the tariffs on the Chinese goods alone is a significant issue. So we got the trade deal with the UK this week, which is great, but really it's insignificant in comparison to the only one that really matters is the trade deal with China.
And as announced, if you've not heard, Trump and Bessent and another advisor are going to Switzerland this weekend. They're having a meeting with a Chinese delegation, so talks are actually beginning in person. And so I think that's kind of what the central question of this week's episode is this the one thing, And it would be really interesting, by the way, if they were to hammer out a deal and the market did nothing. And I who's to say that it's probably not going to happen, but it's so counterintuitive that would happen that it might.
If you hang around, Dan, long enough, I'm going to tell you why I think the market's telling you that a deal is going to get hammered out this weekend. I also noticed in just a headline earlier this week, or maybe it was this morning, they all run together some days, but I noticed that Trump said something to the effect of, it's Bessent's decision as it relates to tariffs. Like he's all of a sudden just delegated this tariff thing to Bessent, which is actually a brilliant political move, right? Because if it doesn't go well, he can say, it was Bessent, it wasn't me all along. So I thought that was interesting to see him start kind of distancing himself from it. Take it what it's worth, I'm not sure, but interesting nonetheless.
The buck stops there, not the buck stops here. Right? That guy. So why does this matter? Yes.
Chris doesn't make me laugh a lot, but that was really good. Come
on,
awesome,
Dan.
Man.
I make you laugh all the time.
That was good. That was not an Ohio State joke though. That was really good. That's comedy.
That's right. Well, okay, so why do the tariffs matter? I mean, it's pretty obvious, right? But this from Apollo showing, what do firms plan to do with those additional costs? Well, they plan to pass that on to consumers for the most part, and especially in the manufacturing side of the world, services not quite as much, but still, the vast majority. Now, there's actually more that are planning to absorb the cost increase internally than I would have expected. And maybe that's because these companies, and maybe even the market is looking at this as like, okay, yeah, it's going to be a price increase, but it's going to be a hopefully one-time price increase rather than like a progressive inflation type of issue. So we'll see. But of course, as with any survey, I'd be surprised if that's actually what happens. Sometimes people respond to surveys differently than what they're actually going to do. Maybe they should have asked the question like that one guy that won the huge election bet when he, instead of asking people who they were going to vote for, he asked, who do you think your neighbor's going to vote for? So maybe they should have asked these companies, what do you think your competition's going to do with with these tariff expenses? So there is upward pressure. Again, this is from Apollo. Upward pressure on the PCE inflation, which is one of the main, inflation indicators that the Fed looks at, that is going to be important because, of course, that kind of puts the Fed in a box. They can't lower rates. Well, they look at it as they have a dual mandate of maximum employment and keeping price stability, which means that they have to keep inflation and deflation under control. And this is a huge, kind of wild card as far as, are the tariffs going to cause inflation or not? And based on the PCE, the prices paid component is moving up across the board of the various Fed surveys. And so the Fed's got to be looking at that as like, okay, well, that could be an issue for inflation, therefore kind of tying their hands when it comes to, rate changes, which is essentially what they said when they had their meeting this week, or at least that's kind of what I took from it was, hey, we're not really seeing good or bad data in the data yet, but it hasn't had time to flow through. So therefore we're not really sure. We got to wait and see what happens.
What is PCE?
PCE is the, you asked me too quickly. Personal consumption expenditures. So it's a mouthful.
So it's like a measure of, CPI in some ways.
Yes.
But on the manufacturing, think of like people who build stuff.
Okay.
Yes. It's it's considered a leading indicator for CPI because before it gets to CPI, the PCE picks it up typically. There's a correlation there.
And this is saying, this graph that I'm looking at is saying what? That right now it's just sort of up in the air?
Well, they do manufacturing surveys across the the Fed system. Now the Fed has systems in, Cleveland and Philadelphia and San Francisco, Kansas. That's why you're seeing the different one, Dallas Fed. And so they all survey, the manufacturers of the prices paid. And then you've got the personal consumption expenditure, which is like what people are actually paying for things. Mm-hmm. On top of that. So it's kind of like expectations, which you can see in the more busy part of the chart. And then you've got the PCE, which is actually what has been spent in the dark green. You can see that's a little more stable, but obviously is correlated with these numbers in some way. So we got a lot of earnings this week, and over the long term, the market, the stock market is supposed to roughly follow earnings. And so the downward revisions have spiked quite a bit, in line with the downward revisions that we would have seen in the financial crisis. Not quite as bad as the pandemic, but still elevated. And it's more so than 22 when we saw the total sell-off in the market. So that's the weirdest thing about this market, is that we really haven't seen a sell-off commensurate with earnings revisions, commensurate with the feeling. So we talk about the sentiment indicator every week. The sentiment indicators have been in the doldrums, and on par with these other, the great financial crisis and the pandemic. And yet the market, thankfully, has not seen that big of a sell-off. So it's puzzling, from that standpoint. You're not seeing that same correlation between those that you would expect.
Can I go with an analogy here? Can I try this?
Let's try it. Go for it.
If Daren will allow me a football analogy, will I have to ask him permission?
You should just do it.
You have a choice.
Just do it. Just go. Okay.
I want you to imagine there's a big football game coming up, a 49ers Cowboys game. And people are buying tickets for this game, buying and trading tickets and selling tickets, and there's prices that are moving for tickets to this game. the game itself may not even happen because of rain. And in fact, it's looking more and more like the rain is going to make the game not happen. But the prices for the tickets and the trading of tickets continues to happen, sort of irrespective of whether the game is going to happen. Sort of just presuming like, it'll be fine. Or even if the game doesn't happen, I'll still sell the tickets. That seems to be kind of what you're talking about with the market and with earnings.
Yeah, sort of like, I guess it would be like, what do you think the tickets are going to cost, right? What do you think the tickets are going to cost based on your expectations of the rain, based on your expectations of who's going to play in the game? Is everybody going to stay out of jail before the game, et cetera? Versus what that ticket ends up costing, right? Like what at the end of the day you end up paying for it. It's sort of like that. The expectations versus what actually comes through. Now, the sentiment indicator, AAII, we're still over 50% negative, so it's definitely still pretty bearish when people are asked. However, the CNN Fear and Greed Index jumped all the way up to 62. Dan, I think you and I are going to remember that number, that 4 on the CNN Fear and Greed Index, and probably bring it up about 100 more times over the next few years. But we're all the way up to 62, which is greed. That's up significantly from even neutral last week. Now, as a reminder, that's how people are actually positioned in the market based on 7 different indicators that they use for that. And then we've got Bitcoin, the leader of the liquidity and risk on score. We jumped back over 100,000 this week, and we're up to 73 greed versus 67 greed last week. So the tip of the risk spear is saying, things look good.
Do they, Daren? You want to take a victory lap there, or you want to say anything?
I don't want to say anything about victory because I just don't do that when it comes to these things. But yeah, I'm going to tell you all about the S&P and how it looks here in just a minute. But I actually feel pretty good about the setup in the S&P, and I'll show you why.
Daren just wants to have time to eat his bananas or whatever you said it was.
They are freeze-dried.
Don't hate until you try it, Chris. These are the Trader Joe's freeze-dried bananas. And I'm a banana fan. I love to exercise. So if you like to exercise, you got to have these bananas.
That's right.
This whole like freeze-dried craze going on in candy. Have you tried some of those? Those like freeze-dried Skittles and freeze-dried, like any of these hard candies, they freeze-dry them.
Sounds awful.
They're actually really like, I love the texture of them. It's a texture thing. But what I like even more is they're like freeze-drying fruit and stuff now that I can eat that and not feel super guilty about it.
I met a guy who sells them, and he had some. Yeah, it was a family friend that I had just met, and he's like, "Oh yeah, I make these," and he hands it to me, and they're just M&Ms that he's freeze dried, and I'm like, "So you sell these?" He goes, "Yeah," and I go, "Well, I mean, do you have to pay anything to M&M, or is this? I mean, just taking their product?"
He was probably a dentist. He's probably a dentist. How can we make this even worse for your teeth? Let's freeze it.
Yeah. Anyways, yeah, I've had it.
Yeah.
I actually looked at a freeze-dried machine because I just love to study like small businesses and like how does it work. And so we were at the Sacramento California State Fair maybe 2 years ago, and there's a booth there that was selling all this freeze-dried candy. And I'm like, what is going on here? And so I looked at like, how much does it cost? And those machines are not cheap, but that's all they're doing. They're just buying these things, freeze-dry them, and then repackaging. Kind of a cool business, actually.
Okay, well, so should we do that instead of financial planning?
Perhaps.
Guys, I got a new plan.
Is there any
it's the
topic?
Curse of the entrepreneurial brain, Dan. It just never stops.
Is there any topic that's potentially more boring than hearing you guys talk about freeze-dried candy? I've got one, and it's international stocks. Okay.
Chris is on fire.
I know there's at least somebody listening to us out there, or will be listening to us out there, that just love the freeze-dried conversation, and that's all they'll remember about everything we say in this.
Yeah. Well, now let's talk about international stocks. This is from Charlie Biello, and he says international stocks have outperformed U.S. stocks by 16% over the last 4 months, which is the biggest 4-month outperformance on record. So, there's been parts of the market that have been doing well despite the struggles in the headlines, right? And I don't know who would have guessed that international stocks would do well, after the election in the fall. I feel like that was maximum pessimism on international stocks. And then had you told people, hey, on top of that, there's going to be massive tariffs across the board, who's going to do well? I can't think of anybody that would have expected international stocks to do well, including myself. I would have been like, wow, that can't be good for international stocks. And yet here we are. So again, you can't know when these things are going to happen ahead of time. Never fall in love with your ideas because you could potentially be wrong. Even the best in this game are only right a little more than half of the time. So, and before you get too excited, right? This is one representation of international stocks, which is the EFA index. And this is from Mike Zaccardi saying, happy all-time high. He published this on May 5th. And he said, happy all-time high, the first since October of 2007. So going on 20, what is that? Almost 22 years, 25 years. Where are we now? 18 years. And so as with any market, you could potentially be in limbo for a long period of time. So potentially, there might be room to run on this. We're just getting back to where we were 18 years ago, plus in the EFA index.
And it's such a good example that one thing that crossed my mind this week was the stock market is unlike so many normal things in our life. When things start going down, when the car starts having more and more and more and more and more problems, it doesn't just magically fix itself and turn around by you doing nothing. You have to start doing something, which when your portfolio starts going down, there is that natural reaction to start doing something, right? So if you're an international investor here in 2008, you're seeing it just go through the floor. I've got to do something. This is natural, human. But the stock market is unlike anything else in that by doing absolutely nothing on its own, leaving it alone, look what happens over the next 22 years. It takes 22 years, but it does come back. Well, not always, but it can.
Mm-hmm. Mm-hmm. That's a very good point. And, a lot of times, especially recently, those stock returns can be very confusing because they're not what they seem on the surface. This is from the JP Morgan Guide to the Markets, and they show since October of 22, which is when some would say this most recent bull market started. If you take Nvidia out of the S&P 500, that's the gray line here, the S&P 500 would have underperformed both Japan and Europe since 2022. Now, I don't have the exact stats, so don't quote me here, but there's something mind-blowing like European bank stocks. I know it's European bank stocks, but I can't remember if it's over the last 3 years or the last 5 years have outperformed the Mag 7. Okay, so that is mind-blowing. Old economy, in Europe, supposedly, the worst place to invest. And those stocks have just done absolutely fantastic. So you got to look under the hood a little bit and make sure that you're diversified as usual, because there's just things that are going to happen that nobody expects, especially recently. Which, speaking of that, here's another chart from Charlie Biello showing the VIX, which is the volatility index, or what I like to think of as kind of a panic index in the stock market. How much are people panicking? And he says the 50% decline in the VIX over the last 4 weeks is the second biggest volatility crash in history. So we had that huge spike when we got the tariffs announced, and then we just got the second biggest, fastest collapse in that panic in history. So markets are moving faster now, good and bad. And so you just got to be prepared for all these things that have, potentially not happened before happening again in the market. Now, when you look at what is the 2-year Treasury rate saying about the Fed, because we got the Fed meeting this week, and they did not lower rates. They kept them the same. That's that orange line that you see here. That's the Fed funds upper limit, which is at 4.5% versus the 2-year Treasury, which is kind of what the bond market or the fixed income market is pricing those short-term interest rates to be, is at 3.78. So a little bit of a spread, meaning that the Fed is tight here, according to the market's interpretation of the rates. When that orange is above the purple line, they're tight. When it's below, they're a little bit loose with their monetary policy. And as we talked about, the Fed is deciding to stay tight because they're not, one, we haven't really seen the deterioration in the market in terms of employment or price stability. So nothing's really changed on that front. And two, they're reactive. They have been in the past. I'm assuming they're going to be reactive here in the future. But as far as the short-term market rates, the betting markets, if you will, not a huge collapse or in that 2-year rate, and not a huge difference in spread between those two, but tight nonetheless.
Chris, when you say the Fed is reactive, you mean that as an institution, they're assessing what is and then take action versus
Correct.
trying to dictate what should be.
That's correct. Yes. With and that's of course my opinion. But when they see a crisis happening, like the Silicon Valley Bank, as an example, they take action once the crisis is clear, but they didn't come out and preempt that. So same with COVID. We knew about COVID in December, and the market started falling in, February or March. The Fed reacted and, came out with the bazooka, after all of that had happened in the markets. And so they're the lender of last resort. They're meant to be there when markets get disorderly. And so they are somewhat reactive as part of their overall function. So what you're looking at here, the headline, this is from Redfin by way of Mike Zaccardi again. Home buyers need to earn over $50,000 more than renters. So talking about the real estate market now, and this is, residential real estate. The red line is how much income is required to afford the typical home for sale versus the income that's required to afford the typical apartment rent. And there's a lot of turmoil kind of going along in the commercial spaces at the moment, and apartments would be part of that. But, a lot of times people feel like, hey, I can't afford a house, I'm therefore missing out financially. I do not agree with that. I do not think that you absolutely have to be a home buyer to be successful financially. Buffett talked about that this weekend, real estate versus the markets. And he was kind of more talking about it from an investment perspective and not necessarily a residential living perspective, which I think you could argue is maybe part investment, but mostly consumption. And so, we're constantly kind of talking to people about, hey, you don't feel like you're completely missing the boat, especially in today's market with real estate. If you're not able to afford it, as far as a purchase.
I will just add this out there anecdotally. There are first-time home buyer programs. There is down payment assistance. There are things that can, if buying a home is a dream of yours someday, and you're listening to this, if you don't have one, there are programs out there that are super annoying with paperwork and you got to qualify, et cetera, et cetera, et cetera. But there are things out there to help you do things that perhaps you didn't think are possible.
That's right. That's right. And so this is from Resi Club, and it shows the home prices since March of 95. So call it 30 years. And you've got the various states, with California leading the way at a 400% increase And then you've got the national average of the USA there at 300%. The state with the least amount of appreciation was West Virginia at 159 over that 30-year period. Now, of course, that takes into account 2008, where you did see losses, but we've seen some pretty dramatic gains since then, which looks great. And but if you look at the next slide, Dan, you'll see what the S&P 500 has done in terms of total return. So this would be dividends and price appreciation since March of 1995, and there's really no comparison. Now, my colleague Gaetano brought up a great point. A big asterisk with this is that that former chart that we looked at, where California had appreciated by 400%, does not take into account the effects of leverage. So borrowing money to buy a property, which is a big yes, that's true. So that other chart is no leverage on the effects of leverage on home prices. This is also no leverage on the effects of the S&P 500. So if you took into account the effects of leverage, which most people put 20% down, so they're 5xing their investment in terms of how much leverage they're putting on, which most people, including myself, would never be crazy enough to go buy a 5x levered S&P fund, right? But there are effects of using borrowed money on those returns that could be taken into account as far as
Chris, I just want you to know that if you ever tell me you buy a 5x leverage ETF, I'm going to call your wife and tell her I'm very concerned and I think something's wrong and you need to take him to the hospital immediately because I think he's having a stroke.
That's right. You'll know that our buy-sell agreement is ready to execute at that point. It's over. It's over for me.
Chris, what are you trying to say though? What are you trying to say though with these two slides? You're trying to say that
I'm comparing the returns of residential real estate versus the stock market. Okay, because a lot of times people will say, especially now, they're like, well, I want to buy a house because I think it's a good investment, right? I don't want to miss the boat financially. And so trying to show them, well, hey, if you're trying to get a return on your investment, the market might be a good alternative for you, right? So if you're buying a house just to live in and it's not an investment and blah, 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 you're looking at it as purely like, hey, this is my home and this isn't part of my investment plan. That's different. But if you're one of those people that says, hey, real estate is the place to be, a home is your best investment. I think you could argue that from a behavioral standpoint because it forces people to stick with it. It forces people to put money into it every year, every month, every year. People prioritize that over everything else, making that mortgage payment. So I think you could argue that behaviorally, but I think it's hard to argue that historically from a pure returns standpoint.
Makes sense.
Therefore, you shouldn't feel bad by putting money into the market, right? Versus real estate if you can't afford a house.
Well, I think this is a really interesting point, right? Because I think that in going back to the psychology of investing that we talked about earlier, and that there was this kind of absence of emotional affect from Buffett, and that probably was part of the reason that helped him be such a good investor all these years. I think there's one of the things with real estate is that the friction to transact is very difficult, right? It's very costly to transact. And so thus it forces people to stick with it longer, which then allows it and gives it the opportunity to appreciate. Because over the years, I've had lots and lots of people tell me, oh, real estate's a great investment. It's way better in the markets. And I think sometimes that's true in markets like in Northern California, Southern California, et cetera, areas that have just really appreciated over the last 20 years, 30 years. But there's a whole swath of the Midwest that really hasn't appreciated significantly. And then the returns aren't great when it comes to rents, et cetera. But one of the things that makes real estate such a good investment is that it forces people in a way just to hold on. Whereas the markets, because it's so easy and it's gotten easier to transact in and to move money in and out, it doesn't force people to stay. And what I'm going to show you in a minute is really we're back to exactly where we were before all this tariff garbage. And you think of all the hype about it that's been pumped into the media at us, it really didn't matter a month later.
And one more thing out the door since we're talking about it. I do think I thought about this a lot lately. Just that, you see the 400% price appreciation for California. You're like, in my lifetime, is my house going to appreciate another 100%? Really? 200%? And what happens? Is there a Roche limit? Is there a point where this finally escapes, the atmosphere, and it's just like, man, I put all this money into my house, and now for reasons, that does that ever come back down, or again, is the real estate market also just up and to the right?
Well, I mean, yeah, I can show you lots of places all through the United States where it's not up and to the right. Areas where industry moved out and it's absolutely decimated. There's lots of instances where that's not the case, and I think there's some element of a confirmation bias exists here in California because of the experiences we've had over the last 50 years or whatever here, that it's just always up and to the right. And I think that's somewhat true, but then at some point, maybe not, and I think when you look at real estate, there's, the big global trends of it or the big market trends. And then you look at, more centralized markets. You take Austin, for example. The real estate in Austin has gone through the roof over the last few years, and it's coming down. And there's a lot of people underwater in those areas, or in Florida, because they bought in high, just thinking, well, it'll just keep going up forever. And that might be true, but it might be 10 years. And whenever I buy real estate, I always tell myself, if I'm going to buy this, it's a 10-year hold. I'm not making any judgment on whether or not I made money on this real estate or not for 10 years. And that has served me well over the years and forced me not to freak out when things aren't where they should be, et cetera. We've gone through 2008, 2001, through COVID. And I think if we could look at our other investments that way, that it's an asset, right? If you're buying truly a good asset, a stock or a bond or an alternative asset, and treat it that way, like you're owning these assets, and hold that through the thick and thin, you're going to be better off. And I think that's what Buffett really taught us a lot and has continued to teach, is like, buy good assets and hold them, and don't dump them when things are weird.
Probably nobody thought to themselves, tariffs are announced, I got to get rid of my house, right?
Right.
But immediately you're like, I got to get out of my stock portfolio, right? Or should I be making changes, or, whatever it might be. And that you just don't have that same behavioral issue with the house investment. That's one huge advantage that real estate has over other types of investments, is the psychology piece of it.
That's a great point about friction too, Daren. I think that's the key.
Yeah. There's so much to that principle, and we teach this a lot when we're teaching our clients budgeting, et cetera, which is, saving money and investing, and is often about the slowing down the velocity of money in our wallets, right? Money comes in, can we slow it down and store some away for a later date? And that money velocity piece is really, really critical to understand. And what real estate does is it creates a lot of friction, and the impact of that is it slows the velocity down, that forces you to slow down and not make emotional decisions about your money. And that's, the tariff, whatever we're going through, whatever you want to call it. I think it depends on what you call it, depends on your politics. And I don't try to be one side or the other. I try just to look at it as a fair shake one way or the other. And this is the AG. So this is the U.S. aggregate bond ETF. So it tracks, in theory, the entirety of the bond market. And this is just one product that's out there. I'm not recommending it by any means, but just a way to kind of get a barometer for what's happening in, quote unquote, the bond market. And you can see when the tariff situation came about, bonds just really started rocketing up, and then they went down. And then we're basically exactly where we were in the bond markets right before all that tariff junk started. Almost to the point, exactly right there. And when we look at the SPY, the S&P 500, you can see we're almost exactly where we were when the whole tariff stuff came about. And we went way down and way back up, and now we're exactly back where we were. And what a great, I mean, this is just a perfect example for investors of like, hey, like all this stuff came at us. The world was ending, blah, blah, blah. We were all going to fight each other and whatnot. And typically the market recovers. When the bond market freaked out, the U.S. capitulated, whether the Trump administration wants to admit it or not. That's another story. But they said, okay, maybe we're doing this wrong because the bond market's infinitely bigger than the stock market. But just a great moment in the lesson in investing. When things are crazy, it's usually the best thing you can do is nothing at all. As long as you own good assets. If you own junk assets that are going to blow out and not be worth anything because it's some crazy hedge fund idea that's far out on the risk curve, then yeah, maybe you better sell it. But if it's good quality, broad market index assets, you just ride it and you just try to ignore all the noise that's out there. So for those who watch this show on a regular basis, last week I talked about the SPY, the S&P 500 ETF trust. And the S&P 500, we talked about this area of right around 569 being really important for the market and kind of a proving ground to see if the market was going to roll over and go back down or go higher. And so what we saw, let's look at the daily chart. So this is looking at the S&P 500 on each day. And what happened over this last week is we came right up into this point of 560. Let's see, the high was 568.92 and rolled over.
You said 569. You promised 569. That was 0.08 away, Darren. I want a better prediction. I want a better prediction than that.
Failed miserably. And it wasn't really even a prediction. So let's be honest. All I did is look at the Fibonacci lines and I said, look, based upon the 61.8% Fibonacci line, which is an important kind of reverberation line for the markets. It's actually a very natural geometric number, and we could have a whole session on the Fibonacci lines. But nonetheless, this 61.8% retracement line on the market is an important proving point for a rebound. And so we've recovered, this being the high up here at 610 on the SPY, went down to 482. Ooh. We've bounced up. We hit the 50% retracement, which is actually not a fib line, but now we're at the 61.8. The probabilities of us going higher increase dramatically if we hold the 61.8 fib line. And that becomes a very, very important point. Now, where the heck did I get 569 from? Well, I looked back on the chart and you can see this little area over here, which was resistance. This was back in November 4th of last year. And we were trading up into that area. And the fact that it traded down into that area and bounced up tells me that that was an important point in the market for us to pay attention to. And so when we looked at that, we got rejected. Rejected means you go up and it gets rejected. It went down, but then we found more support in this area and it's gone back up and held above that 61.8% Fibonacci line, which also corresponds magically with support level back from October 4th, right? And then we had the election and went up and then rolled over. So long story short, looking at the technical data, so barring all the other, in my opinion, garbage you hear in the news, at the end of the day, what the market's saying is there's strength here. The fact that we're claiming 61.8 and it's holding, and now let's look at the weekly chart. So this is looking on the weekly chart, and you can see that 61.8, we were sitting right on top of it this week, like dead center. Like, what's the chances of that we opened at the 61.8% fib line and stayed above it all week? That's a pretty constructive, positive look on the market. That tells me there's support here, there's buyers here. So what does that all support mean? It means there's buyers. What does resistance mean? It means there's sellers. That means that the market's looking at this and saying, we like this, we're going to buy here, we're going to buy here. And that will push the market higher. Now we're going to come into some resistance somewhere around 574 in range. There's going to be a lot of resistance and sellers up in this area. And, but right now the setup actually looks pretty positive. And it's looking pretty good. And that's why I said earlier in the show, if I'm a betting person, this is just if I'm a betting person, I'm betting on magically we're going to see some resolve happen amongst the politicians. And okay, we've agreed, and tariffs are not going to be as bad as we thought they were, blah, 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 blah. Also, what's whispering to us there's strength in the market is the Bitcoin market, because the Bitcoin, like Chris said earlier, is the front tip, the spear when it comes to risk, or at least it's behaved that way over the last few years. And the fact that now Bitcoin is staring at an all-time high and is very close. Now, Bitcoin closes at 5 o'clock Pacific today and then opens up a new candle. We're staring at all-time highs right now. And the fact that we've covered all that in the matter of a few weeks and we're back up there, that's telling you we've got a risk-on atmosphere happening. And then we look at some of the other cryptos that are on the risk spectrum. Ether would be even more risk friendly, and that's even going up. So there's definitely risk back in the system. There's buyers back in the system. There's some push there. It needs to be paid attention to.
When you say risk on, what does risk on mean?
Risk on just means that the general sentiment of the market is buy versus sell. So a completely different sentiment than perhaps we saw, a month ago, where everyone's like, world's ending. This is all bad. What a mess.
We knew it was coming. We should have seen it coming.
That's right.
It's all finger pointing this person's fault.
Yeah, exactly. That's when Trump had his thing like, well, this is the Biden market. Like, I'm pretty sure you said this was the Trump market like a few weeks ago. But whatever. I mean, who's paying attention anyway, right? So this is also interesting. So oil dipped down pretty considerably. It dipped below this 60% line that I've been talking about since last year. And then we traded back above that. So this is kind of saying, maybe there's a recession coming. What I think is happening, and I talked about this last week, I think the government's functionally printing money again and stimulating the economy. And I think that's already coming into the system.
How do we know if that's actually happening? Is there ever like a green light on a website that says like money printing on?
Well, there's lots of different arguments, right? So like one of the arguments is the M2 money supply, right? So that tracks how much money supply. So this is April 22nd, and you can see this tail up. This is how much money in billions is out there floating around, and you can see. And we said this kind of, we had this kind of like tail down in money supply. This is after COVID. So this is the COVID, all the money that got printed, and then it went down here. And then this was going into, so that's December 2024. And they've basically been printing all along. I'm going to change this. And this is confirming that that's continuing out there. So that, in my view, they're probably still stimulating the snot out of this.
When they print the money, where does it go? Who gets it? Where does it go?
There's a great 60-minute. I love this. It was during COVID, and they interviewed Chair Powell, and it was the host, and he's like, "So what happens when you print money? Is it like you just add zeros in a computer?" And Chair Powell said something to the tune of, "Yeah, we just add zeros in the computer."
But then who do they send it to? People are borrowing this. This is where does it? They just start giving away in bags.
Well, there's lots of different ways, right? Like
during COVID, it just showed up in your bank account. Don't you remember that, Dan? Or did you not have your bank account connected? What happened?
I haven't gotten any recently, Chris. I'm trying to buy a Nintendo Switch 2 here, and the money hasn't arrived from Mr. Besant.
Right. Well, it's not just us. It's also what other central banks are doing. And China, announced their stimulus, I don't know, a week or two ago. So, and Europe's stimulating to, rebuild their defense structures. So it's not just what's happening in the United States, it's what's happening around the globe in terms of the money being put into the system. And they do that, via the banks and through swaps on treasuries and reserve ratios. There's all different kinds of ways they can grease the skids of the economy, trying to lower the price of money to stimulate more borrowing. And so there's ways to get that money into the economy up up to and including just dropping people money, what they used to call helicopter money, where they would just like drop it out of a helicopter. Well, they don't need to do that. You can just wake up and check your bank account and there's money from the government there.
Wasn't that so surprising when that happened during COVID?
It was.
Like, they like have our, like, they know all my bank account.
Yeah.
They had no problem putting money in it.
Yeah. You're like,
Anyone
this is awesome. They put money in. And then
delusional.
you think to yourself, like, wow, it's
Wait
awesome they
a
put money
minute.
in, but
I wonder if they can
put
take
it
money
in,
out.
Can they take it out?
They can.
Yeah.
They
Oof.
will.
That was wild, man. I was just like, that was an eye-opening moment of like, oh, okay. When I hear clients too, sometimes like, well, I don't use email and computers, and I just don't want my information out there. I'm like, hey, you have a bank account? Because it's all out there and people have access to it. It's pretty wild. Be interesting to talk to someone who really understands the architecture of how all that works. There's like probably some bureaucrat somewhere in the IRS that has access to all our bank accounts and can push buttons. And
He just got fired.
yeah, he took the buyout of $80,000 to retire. Right. Bad news for us. There's not going to be any helicopter money anytime soon. No one knows how to run the system. So this is the 10-year bond. Why it's super important is because so much of the economy is based upon it, all the loan rates, etc. And watching what happens is the 10 years really important. It's also a very political number. Besant and Trump have been very loud about the fact that they want this to go down. It was also partially responsible for, you could see this was right back when the tariff debacle happened, how fast the 10-year went up. And there's a lot of people that suggest that the reason that we started kind of capitulating on the tariffs and finding ways to step off the course we were headed was because the bond market was breaking. What do they mean by that? The 10 years going up significantly. Why? Because all of a sudden there's additional. So the way the 10-year, if you think about it, the yield, if there's less demand for the 10-year bond, then the yield has to go up to invite buyers to step in. And if the 10-year is going up too fast, there's no buyers to buy government bonds, et cetera. That can be problematic for a lot of the machinery in the economy. So what we're watching, though, is this kind of ascending triangle. And if you can kind of see this here, let's kind of call it this. And you see this kind of ramping up. So I would expect the 10-year to bounce between these two areas, something like that, and then eventually break through or break up. And then it would be some type of geopolitical event that would arrive just on time for that to move, that we would keep an eye on. Magically, right? Like that's what I talked about this week. When last week I'm like, hey, 569 in the S&P, that's the mark. And then we were joking this week. We're like, okay, what news is coming out? And it's just going to switch and change. And yeah, I forget what it was. Technical guys just forget all about like what actually happens. We just care about what the chart says. Let's take a look at gold. Gold started spiking again this week, right? So then everyone started saying, oh, is risk back on? What's going on? And you can see gold spiked way up to almost 3,500 an ounce again, and then dumped back down for the week. So now what you have forming in gold for all those gold bugs out there is a potential double top. And so if you're a gold person, you want to really watch 3,200. 3,280 is going to be an important point to keep an eye on gold. If it breaks through that, then I think you'll probably see a trip down to 3,100 if it breaks somewhere in that kind of range, if we break through there. And that would be a double top, would be a topping pattern for gold, which would actually coincide with the risk on sentiment that we seem to be seeing in the market. What doesn't make sense to me yet, and what I haven't quite figured out, and I'm still waiting to see, is like you have 30% of the docks are empty now. There's 30% of the ships that aren't coming in from China. Like that has to pull through the economy. What I don't know is the government just going to stimulate and make up for that difference? And then so we don't actually slip into a recession. But there are a lot of things like the yield curve that suggest we're headed for a recession, and we could potentially see that. We've had this steepening of the yield curve, and this is one of the yield curves, the 10-year, 2-year. And this is what's called an inverted yield curve when you're below zero. And when you go up above that, that's a reinversion, and that can be a sign of a recession is headed our way or already in place. It's possible. Well, I think we put that at almost an hour. So those who stuck with us, thanks for joining us. I think in general, there's a positive sentiment in the market right now. We've recovered all that we gave up through the tariffs, and what a great investment lesson for all of us out there to remember just to stay the course when things get crazy.
Let's try to answer that question that we asked at the start of the episode, which is deal or no deal. Chris, does the market entirely hinge on tariffs?
I would say no.
I say no.
I
think it impacts it, but I come from the technical side that says the market's going to do what the market does, and the news is going to fit the narrative as it wants to fit it.
So those are some of the things that we're following this week at Sonoma Wealth Advisors. As you can see, it's nuanced. It comes at the market from many different factors, many different levels, many different inputs and indicators. And if you're doing things yourself, or if you're working with someone who maybe doesn't consider all these factors, we would love to talk to you. We would love to share our insight with you if you are not a client already. SonomaWealth.com. You can take our free wealth analysis. And I'd like to thank you very much if you're listening to 1 hour and 1 minute into the show. If you're listening right now, we really appreciate you sticking through to the end. We put these together because we feel every minute matters, every piece of conversation matters, especially talking about freeze-dried candy. So thank you for checking out the show. Wherever you're listening or watching, make sure you subscribe and check out SonomaWealth.com for more. We'll see you next week. Thanks for being on the markets.